Our job is to continue talking about balance sheets. We're going to do a quick review, and then I also want to spend today focusing on one particular item of the balance sheet that we didn't spend much time on yet, and that is bank capital. So we'll talk today about balance sheets, we'll talk specifically about bank capital, and we'll talk about how certain things can change on the balance sheet specifically related to bank capital. All right, so you should remember that a balance sheet looks like this. It's a double list. On the right, we have liabilities, and these are the sources of funds for the bank. On the left, we have assets, and that is the form in which those funds are currently being kept. Since these are two aspects of the same pile of funds, naturally both sides have to add up to the same number. The main source of liabilities for a bank is the deposits that it keeps. It's not the only one, however. You may recall that we discussed that banks can also borrow from each other or from the Fed. And last but not least, this is where we'll focus our attention today, there is also bank capital, which one way or another you can think of as being funds that belong to the owners of the bank. And this all adds up to a certain number, which is 120. Of course, the assets also have to add up to 120 because, again, there is just one pile of $120. There isn't one pile that's liabilities and one pile that's assets. It's just one pile of funds, and each cent in there has two aspects. It belongs to someone, it's a liability, and it's in this particular form. It's some kind of asset. So one thing that you as a bank might do is nothing. To some extent, you need to keep funds in some sort of cash form, in other words, as reserves, because you may need to have some on hand in case the depositors come along and want to withdraw, or if someone writes a check, you have to, which is also a withdrawal of funds, or in case you have to pay any of your borrowings, and so on. So the banks always need to have some reserves. In addition, the rest of the funds are lent out in some form or another. They could be lent directly as loans, or they could be lent through the purchasing of securities of one form or another. And these are the same numbers that I think I used last time. So I said that we would discuss how balance sheets change. We already did a little bit of that. We discussed what might happen if someone makes a withdrawal, or if a bank sells some securities. Those are those are one kind of change, and they involve well, that's not actually what I want to talk about, because today I want to focus on bank capital. But if you go into Blackboard, you will see that if you go under exams, there is a document there called Balance Sheet Practice. So if you want, you can go and have a look at that to try and see how day-to-day transactions affect bank balance sheets. What I want to do today again is to observe the following. First, I want to talk about a slightly different way of thinking about bank capital, and then I want to show how bank capital might change. So we discussed bank capital as being funds that correspond to the owners of the bank, but here's a slightly different take on it. The total value of the funds at this bank is 120. Right? That, of course, equals the total value of all these assets over here. On the other hand, the bank owes this much, 110, to various other people. Right? So it has a total of 120. 110 belong to other people or entities. So if you take the total 120 and subtract the 110 that belongs to other people, this bank capital is what's left over, so to speak. Left over for who? Left over for the owners. That way of thinking about bank capital is useful because we've been talking about balance sheets as being things that are static, largely, but in reality, they may change over time. In particular, the value of these securities may change over time. We know that, right? Because we've discussed that many times. We discussed the whole topic of interest rate risk and capital gains and losses revolves precisely around the idea the value of securities can change over time. And that's true for the bank as well. So let's see what happens to a bank balance sheet when the value of some of the assets that it's holding changes. So to pick an example, suppose some of the bank's securities gain value. Let's say they go from, right now the total value of securities is 50. Let's say it goes up to 51. How is the balance sheet going to change? Well, this is no longer 50, right? The assets gain value, so now it's 51. This is no longer 120. It's 121. And of course, this is also 121. Why? Because the total value of the assets that the bank controls has risen. Now, I obviously haven't finished making changes here because, as written, the liabilities don't add up to this new number. So one of the liabilities must have changed when the assets gain value. The question is, which one? Did any depositors show up and withdraw funds or increase their deposits? No. All that happened was that some securities gained value. So that doesn't change. Did the bank just go out and borrow a bunch of funds? No. Just some securities gained value. So it's not the borrowings either. It must have been the bank capital that gained value. In what sense? Did the owners come and give it some more money? No, that's not what happened. What happened was that, again, if you take all the assets, that's 121, and subtract all the stuff that you owe other people, that's 110, you end up with 11 left over. Left over for who? Left over for the owners. So when assets gain value, the bank's assets, what that does is it means that that extra that's left over for the owners has become larger, which of course makes the owners of the banks very, very happy. Any questions, thoughts, comments? Similarly, of course, if the assets lost value, that would also have something to do with the bank capital. So let's go back and look at that case. suppose that some of the assets that the bank is holding lose value. Let's say they go from 50 to 49. A small loss. Let's go through the same exercise that we went through before. The securities here were worth 50, but now they're worth 49. That means that the assets are no longer worth 120, we're down to 119. Something has to change on the liabilities side to make this whole thing balance. What is it? Well, again, is the deposits? No. No depositors did anything here. It's just that some of the securities lost value. So that doesn't change. Is it the borrowings? The bank hasn't changed its borrowing behavior. It's just that some securities lost value. It has to be the bank capital. How so? Well, we take all the assets, they add up to 119. All the liabilities to other people add up to 110. How much is left over for the owners? None. So when assets lose value, when the assets the bank is holding lose value, what it does is that it reduces the bank capital. So what's left over for the owners has declined. Any questions or comments about this? Okay, now I want to do the same thing with slightly different numbers. Suppose some of the bank's securities lost value, and suppose that it wasn't from 50 to 49. Suppose it was a much bigger loss of value. Suppose it was from 50 to 39. What happens here? Well, first of all, let's start with the securities. They were worth 50, but now they're 39. So let's replace that there. That means the total assets are no longer worth 120. They're not 119. They are 109. Right? So far, so good. Where did it come from? One of the liabilities has to change here. The deposits haven't gone anywhere, right? And the borrowings haven't gone anywhere. So it has to be the bank capital. The bank capital is what's left over for the owners. So that's 109 minus 100 minus 10, which gives us, oh dear, a negative number. What does it mean for bank capital to be a negative number? It means that if you took the total value of all the assets controlled by the bank, you would not be able to cover all the bank's obligations to other people. That doesn't look good. When a bank is in this situation where the total value of its assets doesn't cover anymore the total value of its liabilities to other people, we say that the bank has become insolvent. And notice, of course, that tells you that bank capital isn't just money that's owned by money that corresponds to the owners of the bank. It also is serving a special role here as a cushion against possible negative shocks to the value of the assets of the bank. If you had a lot of bank capital, you would be able to survive a bigger loss in the value of your assets without becoming insolvent. What happens if a bank becomes insolvent? Well, this bank can no longer meet its obligations, so it would probably be shut down. The FDIC would step in and pay the depositors that these assets can't take care of, but the bank would likely cease operations. So there are two things that happened here, right? One is there was a large negative shock to the value of the assets, and two, the bank didn't have enough bank capital to cover it. So if you're a government official and you're looking at this, the risk of something like this happening, what might you think of as being a regulation that you might create to try and deal with these possibilities? Well, remember that we have there's this risk of bank runs, and one reason why we might have them is because people might think that the bank doesn't have enough reserves. So we deal with that by having reserve requirements. If the risk here is of banks becoming insolvent because they didn't have enough capital to deal with a negative shock, why not have capital requirements? In fact, there are capital requirements. They are such that the capital requirements are different depending on what's on your balance sheet. So if you're holding securities that are viewed as being very risky, then your capital requirement is higher because you're more likely to experience these losses. If you're holding a whole bunch of really safe assets, then the capital requirement is lower. But there are capital requirements. So going back to this example, if something were to happen to a particular bank that meant that it was insolvent, as I was discussing, it might get shut down, its assets and liabilities sold off to pay the depositors, the FDIC might step in, and then the bank is gone. But what if something like this were to happen to lots of banks at the same time? What I mean is, suppose this class of securities that lost value is something that all banks are holding. Like what? Well, for example, in 2008, all banks were heavily exposed to mortgage-backed securities, and suddenly house prices collapsed and people started defaulting on their mortgages, and all the banks started to experience a loss of securities value at the same time. Now we're not talking a problem at one bank, we're talking about a problem at all banks. And then we're not talking about one bank being insolvent, we're talking about possibly the entire financial system coming to a screeching halt. So when we're seeing a whole bunch of banks becoming insolvent, or maybe not insolvent, but many of them are losing funds dramatically in this fashion, then what we're looking at is what's called a financial crisis. If you look at chapter 12 of our textbook, you will see that Mishkin thinks that financial crises often follow a predictable pattern, in that they may get started by different factors. Like in Argentina, it had to do with the currency dramatically and suddenly losing value. In the United States, it had to do with mortgage-backed securities. We'll look at some other examples. Let's say, for example, in maybe 15, 20 years ago, the government of Greece defaulted on its debt. You can imagine that just like in the United States, all the banks in Greece, among their securities, had government bonds. What if the government defaults on its debt? Again, all the banks are suddenly put in the same situation of, well, what's drawn here on the whiteboard. You can imagine it would be total chaos. So the initial causes may be different, but once things get going, what happens afterwards follows a fairly predictable pattern. And to think about that pattern, I put together in Blackboard, so I'm going to go to Blackboard to show you where it is. Here, under exams, there are a few things. One is the mid-semester check, that is a survey that I mentioned to you before. If you haven't filled it out, please feel free to go in. I already got 13 answers. There's this balance sheet practice sheet that I mentioned to you, just to sort of track different things that might change balance sheets. What I want to look at now is this one, the financial crisis worksheet. So please open it up. We'll work through it together, and then we'll see if we can reason our way through to what are the predictable things that might happen once a financial crisis begins, even if the initial cause might be different in different cases. Okay, can you see it? Okay. Previously, when I put together a worksheet of this kind, I would then put you into breakout rooms so that you could work on it by yourselves. But what I found so far with the mid-semester check, that survey that I just reminded you of, is that several students felt that the breakout rooms weren't terribly effective, and that it would be better instead if we worked through the worksheets in class together. So why don't we try that, going through it together instead of in breakout rooms, and see how it goes. Okay? So here is the financial crisis worksheets. First, the setup. You are the owner of a bank, and you're operating your business as usual, and then one day you find out that there's this new thing out there, mortgage-backed securities. They didn't exist before, but someone figured out how to create them, and now here they are. And you think they're safe, right? You're a bank operating here in the DC area, and your mortgages that you issue are all related to homes in this area, and that gives you some risk, right? If all your lending is in one area, then if something goes wrong in this area, you're exposed. But these mortgage-backed securities are awesome. They pack together mortgages from Fairfax, Virginia, and Fresno, California, and Tulsa, Oklahoma. They're all mixed in together. So the risk of what might happen in any particular place isn't there. And you think these are great investments, and you buy $200 million in mortgage-backed securities. Okay, that's this part. Additional information is that your total assets are this number, 1,100 million, and your capital requirements are 10%. If your capital requirement is 10%, then that means that you have to have at least 110 million in bank capital. So let's say that's what you have. All right, so you have 200 million in mortgage-backed securities, which are a new asset that came along that seemed like a good idea. Total assets are 1,100,000,000, and you have 110 million in bank capital because that's what the regulator requires. All right. Next. One day in 2008, you wake up and discover that your assumptions about how mortgage-backed securities work were wrong. In fact, what's happened is that mortgages in Fairfax, Virginia, and Fresno, California, and Tulsa, Oklahoma are all defaulting at the same time, which is something that you hadn't really contemplated. Moreover, you're not quite sure exactly which mortgages you have, whether they're good or bad. So one way to think about this simply is that you wake up and discover that some of the mortgage-backed securities are indeed good, safe, have a good return, but there's a bad version of them. And just to make things simple, let's say there's a bad version that's worth half of the good one. You can't tell which ones you're holding, but unfortunately, there are some people out there who can. This is a classic situation of adverse selection, right? There's some people who have these assets who know which are the good ones or the bad ones. They would want to keep the good ones. Why? Because knowing that there's a mix of the good and the bad out there, no one is going to pay the price of the good version. If you have the good version and you know that it's a good version, you're not going to sell it, you'll hold on to it. And that means that all the ones that are being traded are the bad version. So, given that we're entering a new situation of adverse selection, how much are your mortgage-backed securities worth now? After the discovery that there's an adverse selection problem going on with them, and there's a bad version that's worth half of what the other one is. Well, any ideas? You can put it in the chat. So the idea is, in an adverse selection situation, an extreme one, as discussed, only the bad version will circulate. And so the bad version is worth half of the regular version. And so that means that your mortgage-backed securities are now worth 100, exactly. Which is a problem, because now your balance sheet has changed. This is an example where, again, your securities have lost value. So what is your bank capital now? Well, to start with, remember, the bank capital was 110. But now we've just experienced a loss of the value of our assets of 100. And you remember, when that happens, that comes out of the bank capital. So the bank now only has 10 left over. What about the assets? Same thing. The bank started with 1,100 million in total assets. They've lost 100 in value. So what they have left over is 100. Sorry, 1,000. Finally, what is your required capital now? Well, remember, the capital requirement is 10% of the assets. So the capital requirement is 10% of 1,000, which is 100. How much do you have? You only have 10. So you're not insolvent, but you are in violation of your capital requirements. And even if there weren't any capital requirements, you would still probably want to get some more capital somehow, right? Because you're in danger with such little capital. So obviously somehow we're in a situation now where the bank needs to get more bank capital urgently. Yes, let's see. Are there legal repercussions to violating the capital requirements? I guess. I'm not sure what the penalty is, but no one does it. I mean, unless you're totally insolvent, you're supposed to be able to well, you have to raise capital. Right. So I will look into exactly what happens to you if you violate your capital requirements. I'm assuming that there is a very severe fine involved in that. So okay, so we've established that the company needs to increase its capital. What do you have to do? You have to somehow get more capital from the owners. Do you think the owners would be happy to put capital in this bank? Any money that they put in is going into a bank that's doing badly. So as far as, so they're under pressure to put money in to keep the bank safe or to meet the legal requirements. But that money isn't exactly going after a good investment. So they'll probably be reluctant to, although they have to. The question is, where would you, the owner of this bank, get funds to top this up? One possibility is that maybe, aside from your ownership stake in this bank, you probably are a wealthy individual, so you have other assets, bonds, shares, and so on. So one way you could earn funds to stick into your bank and boost its capital is to sell other assets. Now here's the question. Suppose you're trying to raise capital by selling assets, and remember, you're not the only one doing this. There are a lot of banks who are in the same situation because they all had mortgage-backed securities. So what's going to happen to asset prices if everyone suddenly starts selling assets at the same time? Well, if you think of this as an increase in supply, of course, what it means is that asset prices would drop. And if asset prices drop, what does that do to the balance sheet of the bank? Well, remember, this whole problem started because some of its assets, some of its securities lost value. Now there's this additional factor pushing securities to lose value. The fact that everyone is selling off assets to try and raise funds. And of course, indeed, what that does is it lowers bank capital even further. So we've sort of entered this downward spiral of deteriorating balance sheets. Now, another option, I guess, is that you might say, well, instead of selling assets, maybe I have a bank account somewhere, right? And then I raise capital from my bank by just withdrawing funds from my account. Well, if you do that, that bank where you took your funds out suddenly is low on reserves, and they'll have to somehow top them up. And one way of doing that, of course, is going to be by selling assets. You might say, well, why they could borrow, but no one's going to lend to them right now. Everyone is busy trying to shore up their liquidity and their capital. So they would probably have to sell assets. And so in this case also, again, there's this additional pressure. Lots of banks selling assets to try and top up their reserves. Means further pressure, on asset prices going down. So again, are banks in a better position or a worse position? It's all getting worse and worse. As Marshall pointed out, so first we have these big losses. In this case, it was from mortgage-backed securities. But then once this happens, because it's happening across the board, all the banks have to, in order to raise capital, they have to sell off other assets, or the owners have to sell off other assets. In order to boost reserves, they have to sell off other assets, which pushes down the value of all the assets and makes the balance sheet situation even worse. Another thing that came up in this discussion was, again, that because the banks need to boost their reserves, that also means that they're not going to be lending as much to anybody else, including each other. That's going to matter in a second. Any questions or comments about this particular example? So having gone through this particular example, the next thing I want to do is to try and use it to go through, as I mentioned, what Frederick Mishkin views as being the sort of common factors behind all financial crises. So I was saying the initial thing that gets them going may be different from case to case, but what happens later tends to be fairly predictable, unfortunately. So let's do that and look at Frederick Mishkin's 3 easy steps to have a financial crisis. I call this anatomy of a financial crisis. So first of all, we need something to set off the crisis. So step 1, initial phase. In this case, the initial phase, so well, broadly speaking, the initial phase would be something happens that leads to, in this case, what happened was the mortgage-backed securities came along. We all thought it was a great idea to buy them, but we didn't really understand what was going on. And so I'm going to refer to that idea as financial excess. So lots and lots of people or banks are doing something, not realizing, doing something in large numbers they don't realize is unwise. And of course, eventually, that translates into widespread losses. In our example, what happened, or what set this all off, was what we could call an example of financial innovation. Right? The mortgage-backed securities came along, and people didn't fully understand exactly what were the risks involved. They thought they were safe, highly diversified assets. They didn't realize that they carried this systemic risk with them. But there could be other things that, well, there's another example of financial innovation. When derivatives started to become popular in the 80s and 90s, a lot of people remember that if you're buying an option, let's say, you're protecting yourself from certain downside risk. But if you sell an option, you're exposing yourself to unlimited downside risk. And so even some governments were involved in options markets, which isn't exactly the job of the government, right, to get involved in options trading. And then some governments lost huge amounts of money, like the government of Orange County, California, went bankrupt because of their derivatives trading. That's a different example of financial innovation, being the initial problem that led to financial excess. Another example that the text mentions is financial Well, the text called it financial liberalization. Suddenly I'm forgetting how to spell liberalization. And what that means is that the government may have relaxed the regulations surrounding financial markets. So, for example, what if, let's say, the government decided to relax capital requirements, let's say, or lower the required reserve ratio. That would lead to a boom in lending, right? The banks would suddenly find themselves with all these extra funds that they can lend, or they wouldn't need to have as much capital, so they might, well, withdraw capital, and thus exposing themselves eventually to risk. So financial liberalization, the relaxation of regulations, might also lead to a sudden change in lending behavior that involves taking on undue risk. Another possibility is, I'm going to call an asset price bubble. So every now and then it happens that having some particular kind of asset becomes fashionable, and then suddenly, so people are buying it thinking that its price is going to continue going up. And then, of course, the price of assets should only be going up if the payments associated with them are going up. If they're not, then they shouldn't. And so in an asset price bubble, the price of something keeps going up beyond those payments, and eventually, of course, that means the asset price has to collapse. Some would argue that that's what happened in 2008, that there was a bubble in home prices. And the popping of the home price asset, the house price bubble led to the people defaulting on their mortgages a lot, which then led to the problem in the mortgage-backed securities, and so on and so on. Another possibility, and there was a recession in 2001. I guess it didn't cause a financial crisis in the end, but there was a major recession in 2001. There was probably a stock market bubble before that. There was all this hype about, this is when companies like Amazon and so on were just being born, and people were freaking out, saying how we had entered a dot-com bubble. We'd entered this new economy where stock prices would rise much faster and economic growth would accelerate, all because of these new internet technologies. They were wrong. Okay, they were right in some sense. Things changed a lot, but it's not like we had suddenly much more rapid economic growth for the foreseeable future. So that's another example. And another example that the text has is that it says that an increase in uncertainty could do this as well. Now, my view or my interpretation of this is the following. We know that when we're doing investments, we're doing our best. We're trying to diversify. We're trying to identify profitable opportunities. But we also know that in the background, there's always systemic risk, right? There's that nagging systemic risk that you can never fully get rid of. Well, every now and then, that systemic risk is going to materialize, right? However well you're diversified, that systemic thing might just come along, and that's just part of life, right? Let's say the Fukushima disaster. That was an earthquake followed by a tsunami, followed by the destruction of a nuclear power plant, causing a nuclear disaster on top of everything else. That nuclear power plant had been built with special walls that were designed to deal with tsunamis, but not with a tsunami of that size. Now, a tsunami of that size, I read, is referred to as a 500-year tsunami, like a rare event. What do we know about a 500-year tsunami? It may be a rare event, but one thing that you know is that it's going to happen sooner or later. So my interpretation of this so-called increase in uncertainty is more like they are bad things. We can't totally guard against them. They're going to happen sooner or later. So no matter what we do, financial crises are probably going to hit, even if we try our best. So that's the initial phase. Something happens that leads to financial excess, or maybe, as I was saying, maybe it's just a rare event that gets you into trouble, that the text refers to as an increase in uncertainty. That's step one. In the comments, I was told that the slides get cluttered, or they're hard to read if we put too much on them, so let's just, in response to that, let's start a new one so that we can discuss step two. Banking crisis. Looks like banking crisps. Banking crisis. This is the part that we focused on in our worksheet. As a result of these significant losses from stage one, a lot of banks lose a lot of capital and either have to bend over backwards to try and raise more capital to survive, or in some cases may even be insolvent. In the 2008 financial crisis, there were some banks that went insolvent and were shut down, and their depositors did have to get money from the FDIC. So this definitely happens and can happen again. What Michigan points out is that the public doesn't necessarily know exactly. So we know that many banks are in trouble, but there are also many banks, and some may be in more trouble than others. It may be hard to tell which is a good bank and which is a bad one. In fact, the banks themselves may have trouble telling whether that bank over there is in trouble or in real trouble, or not in trouble at all. Because remember, especially in this case where the whole point was asymmetric information and adverse selection in the mortgage-backed securities market, you don't, even if you know how many mortgage-backed securities different banks have, because you can read their balance sheets, you still don't know which ones they have. So things like these overnight loans that banks make to each other now suddenly might no longer function, because there might be asymmetric information about the banks themselves, or adverse selection, right? If a bank comes to you and asks you to lend them money, you'd think, well, if they're lending money, they're probably more likely to be a troubled bank than a healthy bank. So I'm not going to lend to them. Anyway, I need the money myself because I need to boost my reserve requirements. So suddenly, now it's no longer just the mortgage-backed securities that's a problem. Now suddenly the banks are in trouble, and they're not lending. In addition, to boost their reserves or to try and raise capital, the banks and other people are selling assets And as we were discussing, since this is happening en masse, everyone is doing this at the same time, that leads asset prices to decline. So now it's, again, not just the mortgage-backed securities or whatever it was that started this whole process off. Now it's all asset classes losing value. And that leads the balance sheets of banks and other companies to deteriorate even further. These sales of assets that you're doing not because you're tweaking your balance sheet, but rather because you're massively trying to raise cash, and so you're just selling whatever you can, is referred to as a fire sale of assets. So now we've started this sort of, again, we've entered a downward spiral where one thing, everything that happens is making the balance sheet situation worse. And finally, and this is something that we didn't get to in our worksheets, there's the third stage called debt deflation. And what's that? To think about this, we're going to need to have in mind our macroeconomics. So reach back into your brains and find the macro Econ 1012 that you may have done, or 2102 if you've done intermediate macro, that you may have done in the past. So the banks are not lending, right? And people are losing their savings and their wealth. So as a result, this is well, since you're having trouble borrowing and you're losing wealth, one of the things this is going to do is that it may make spending on goods and services collapse. Right? If you're defaulting on your mortgage, obviously you're not going to go out and buy a whole bunch of stuff. So spending is collapsing. And well, just intuitively, if this is a massive demand shock for the whole economy. If everyone is buying less of stuff, just intuitively, demand decreases for something. In this case, demand is decreased for everything. What does that do? Well, first, the quantity of goods and services exchanged would decline. Second, just imagine a supply-demand diagram in your head. The prices of goods and services would decline as well. We call that deflation. Why does that matter here? Well, remember when we talked about inflation, the only time we talked about inflation so far was, well, the main place where we talked about inflation so far was when we were thinking about the difference between real interest rates and nominal interest rates. All right, so real rates equals the nominal rates minus inflation. So in that context, we were saying we were thinking about when inflation ends up being higher than you initially expected, that means that since the nominal rate was something you agreed upon when you wrote your contract, if you're a borrower, that means the real rate that you're paying back declines, which makes you happy. So borrowers like surprise inflation. That was one context in which we discussed it before. But now what we have is the opposite. We have surprise, unexpected deflation. When inflation drops, okay, in this case it's even deflation, and you borrowed at some rate, that means that the real interest rate that you're paying back will have increased. In other words, this deflation makes the real rates paid by borrowers on outstanding debt goes up. So it's becoming harder and harder and harder for people to pay off their debts. And of course, what does that mean? It generates another further round. So we started with some losses in some asset class. That was the initial phase. But if those losses are large enough and it's on an asset class that all the banks are holding, then now we have a second stage where the banks are the ones that are now suffering. They stop lending and they start these asset fire sales that further lower asset prices. Eventually that harms the real economy. When it does so, prices of goods and services, the prices of goods and services go down. It makes the rates paid by borrowers go up, so it makes the real cost of outstanding debt go up, and that leads to defaults on just any loan, basically, because any borrowing contract that pre-existed the deflation is going to be affected by this. So we have this downward spiral that could start anywhere in the financial system, but if it's big enough or bad enough, it will spread all the way through it and affect pretty much everyone. Any questions, comments, thoughts about this? So again, the details of each one, are there ways to stop a deflationary spiral? Well, what can you do to stop this happening in the first place, I guess, is right. I guess so let's do two things. First, to directly answer your question, what the Fed tried to do was to print money like crazy. So monetary policy. Fiscal policy didn't do much in that occasion because, well, fiscal policy depends on politicians, right? In the United States, the Congress would determine the responsive fiscal policy, and they don't always agree among themselves. But in monetary policy, they can act fast, and so what they did is several things. One is, well, let's think about this. There are several steps here at which some entity might intervene to try and stop the crisis from getting out of control, right? What if you could avoid things getting to this stage? So here, the problem that makes the initial phase spread into the banking crisis is that the banks are losing capital and becoming insolvent, right? So what if you could avoid that? How might you avoid that? Well, what if the government comes in and just gives money to the banks and says, here's some capital? That might work. Whether it would be politically popular or not is another matter, but that's one possibility. But of course, that isn't always going to work. For example, remember one of the examples I think I mentioned was the case of Greece, when the initial phase was that the Greek government defaulted on its debt, and of course all the government bonds became worthless, and all the banks were holding government bonds. The Greek government obviously can't bail out a financial sector when the whole problem was that it doesn't have enough money to even pay its debt. So in that case, in that particular case, what happened is that there was a bailout of the Greek banks, but the funds came from outside. The European Union and the IMF helped to put together some sort of bailout package. Another possibility, which is similar is that the banking system is nationalized. That's different from the banks, from the government just giving bank capital to the banks, because the government is also taking control of the banks. Now, there's some flavor of that in what happened in the United States. The government didn't take control of the banks. What they did is they bought up all these mortgage-backed securities. Remember, one of the problems is you have these mortgage-backed securities, some of which are good quality, some are bad quality, and the key thing is it's really hard to tell which is which. Well, what if the government buys all of them? No more adverse selection problem. And then they spend years combing through each mortgage-backed security to try and determine exactly what its quality is. And then they sell them. That's what happened. So first they bought them at a slightly inflated price so that the investors got something. And then they sorted through them to figure out which were the good ones, which were the bad ones. And of course, once that process is complete, there's no more adverse selection problem. The good ones get a good price, the bad ones get a bad price. And so what happened at the end was that the government, that particular program by the government actually made money. And it makes sense, right? If you buy something cheap and sold because that's cheap because of adverse selection, and then sold the adverse selection, now suddenly the good assets are worth a lot. So that was a success. Although that obviously isn't necessarily going to generalize. That the ability to do that depends on what is the initial problem that got out of hand in the first place. Although I guess it does have a similar flavor of nationalizing the banks. Let's get started. 3, 2, 1. First question, true or false? When a bank owner adds bank capital, it lowers the owner's profit rates. Think about the case when the bank is doing badly, but we'll discuss next time that this is always going to be true. It's true. Next. True or false? Capital requirements are higher for banks who hold risky assets. Would it make sense to set up capital requirements that way? What do you think? All right, everyone got that right. Very good. Third question, what is the bank capital of this bank? So here is a balance sheet. We must figure out how much bank capital this bank has. Okay, almost everyone got it right. Very good. Fourth question, suppose this bank securities lose 7 million. How much bank capital does it have left now? Six, 5, 4, 3, 2, 1. All right, good job. Well, if it had 10 and lost 7, it has 3. This one, you have to sort things into order. In order, the 3 stages of a blank are blank, blank, and blank. And when you're done, you have to press the K button to submit your response. One person is thinking very carefully through this. All right. Meher is still ahead. Last question. If bank capital drops below 0, the bank is what? Read carefully. Insouciant. Okay. Very good. Almost everyone got that right. Let's see how we did. Eamon is in third place. Good job. TJ is in second place. Nice work. And at the top, having developed an insurmountable lead from this question, it's Meher. Good job. So, Meher, what filter would you like me to look for?
We can do a puppy dog filter.
I'm sorry? I didn't hear what you said. Do you want to write it into the chat?
Hello, I'm not
Meher,
sure.
I can't hear you.
Oh, okay. I was saying a puppy dog filter.
Puppy dog.
Yep.
Let's see what happens if I write puppy. Okay, that's not working very well. Someone needs to work on their programming, it seems. How about this one?
Okay, yeah, anything.
Or this one? And here's another one. All right. How's that one?
That's fine, thank you.
All right, great. Thanks, everyone. Hope that was useful. Feel free to talk to me in office hours. If not, we'll see you on Wednesday. Thanks very much. Take care.
Thank you.